All right, my favorite people, Sterling White here, and back at it again with another topic for you. You may be seeing me flex my muscles here. Some of you may not be paying attention or not able to actually visually see this, but today's topic is going to be on how I obtained a 156 unit apartment complex using multifamily syndication secrets, where they're not really secrets. Most of you know these, but they actually may be secrets or things that you are not aware of or not currently using. So you'll definitely want to stay into the very end, because I'm going to go into how this deal was put together from start to finish, and it's going to be quite a bit of content, so definitely get your popcorn ready. Appreciate you. All right, first and foremost, I want to go into how the deal was found. And this is in the backyard of Indianapolis, Indiana. And the most interesting story I want to share with you, which really goes to show what happens when you put in the work, is I remember visiting this property as a kid, one of my friends, and never thought one day I would actually be owning it, because that just goes to show you what is actually possible out there. I believe I was somewhere in my mid-teens when I went to go see them. So there's that. And I would drive past the property just about every day on the way to Avon. It's more of a suburb out there in the just outside the city. But let's go back into it. So the deal was found, so was pulling multiple lists, and there's a variety of platforms that you can use, not affiliated with any of these, but two top ones on the commercial side, meaning property over 5 units is considered commercial. So Reonomy is a good tool, as well as CoStar. They're a little bit pricier, and of course the price is subjective whether or not that's expensive, but the ROI is there. So started pulling lists, and then also cross-reference Google oftentimes to find if there's some that may end up falling through the cracks. But most of these data providers do have the properties. So ended up pulling the list, dropping it into a CRM that does the outbound calls, because I take the approach in going direct to owner, and had someone on our team. Her name is actually Maria, who actually made this contact with the owner of the property. And so with that is how this worked is it was a huge spider web. And what I mean by that was this was a syndication that was put together about 2 decades ago. So it was, and all this came together with finally getting in touch with the owner about a year and a half later. But with that is, I remember doing some researching, having to go really into detective mode, saw a ton of obituaries, so people dying that were formerly associated with the property, and then ended up finding someone just through all that with a very unique last name. I don't want to drop the last name because it's that unique. So what I did was I used this site, which is a great site to do skip tracing, which is, go ahead and grab your pen and paper available. Go ahead, I'll pause for you real quick. It is Google. Most of you know that. Shout out to Gary Vee, I got that from him. And so I used Google and found someone who was actually out in Florida with that very same last name, who was in real estate. So from there, Maria actually gave him a call, and he says, yes, I'm actually one of the decision makers involved with the property. And then from there, just gave him the simple pitch. Hey, interested in purchasing your property. Would you consider an offer there? So the appointment was set for me, and then I had that conversation, and then they said, yes, we would be open to it. And there were essentially 2 decision makers, and then they had their investors, which also, in order for them to sell the property, they had majority vote, but they also had to get some minority votes from them too, to fully be able to move forward with the purchase, the sale of the property. So that's how the deal was found on the front end. But now I'm going to actually go into more details on the underwriting, because this is where a $1 million mistake was actually made. All right, so at this time, received some financials from the owner, and we're now opening the dialogue, starting the underwriting side. And myself is I plug in the rents and make assumptions on the renovations just based upon other properties nearby and what we done to those properties, because these were in similar conditions to those. So we were able to leverage that and make assumptions. But the thing is that you'll be able to confirm confirm your assumptions once you're actually in due diligence, unless you're able to have a contractor go out there and, let's say it's roofs, let's say it's HVAC, and then let's say it's windows. If you can get that, but most times most won't go through the entire process like that. They'll make assumptions on the front end, and then later when they do their deeper dive, that's when they'll look to confirm and really get the actual cost of items. But some people do it on the front end because they actually have to do that to actually be even more competitive, and it shows more serious. But I don't want to go too far off course. So ended up submitting a verbal offer to the owners of $7 million. And at this point, they actually accepted it and then was going to send over a LOI, and ended up getting our COO a second set of eyes, a third set of eyes. And essentially with that, she said, I would not feel comfortable pushing those rents up to what you have there. So essentially, on the upfront end, it was my fault. I accept accountability for this, responsibility for it, that I was aggressive about $65. So if you consider, it was by about between $50 to $75, but if you consider that on 156 units times 12 months, that is a huge swing in the income. So at that point in time, this is where it got tough, because it's like, just had this conversation, had the thinking, don't want to lose this deal. And I remember Jacob and I actually got on the call with both of the partners, and we thought the conversation went well. It was about it was a very lengthy conversation, and essentially what was being said that, hey, we're asking for a $1 million discount. You're going to take more of a haircut, is essentially what we were saying. So I wouldn't say haircut, but asking for a discount. And so from that is, we thought, okay, that was received well. And then Jacob actually sent a follow-up email, and the owner, one of the guys, blew up and he said, I didn't know that's what you were asking. There's no way we're going to ask that. And then at this point in time, we're actually going back and forth, and we ended up settling on a price reduction of actually $800,000. So at this point, we submitted the LOI, and then now we go to the actual contract, and we're in the due diligence phase now, which is the fun part. And one thing I want to mention on this before we go into it, this is the importance of having a team. So now we're in the due diligence phase, of which the contract includes 30 days due diligence and a 90-day closing time frame. And one of the concerns that was on the front end of the underwriting was that the water was very high, abnormally high, and we believe that was actually due to slab leaks. So during due diligence, that's one of the things that we actually wanted to uncover. And then also the roofs, is whether or not that those needed to be replaced sooner rather than later, because that is a large expense. So those were some things that came up, of which we made assumptions on the front end of, okay, this is what we're buying the property for. These are the renovations we're putting into it. This is what we're pushing the rents up to, or what we believe we can push the rents up to. And this is our exit by us increasing and executing on this business plan and selling the actual property, and put the projection on the 3 to 5 year window. That's typically what you'll see on a syndication. So through the due diligence, this is a very simple process. I wouldn't say simple process, because there's tons of moving parts. And if you want a link to the due diligence list that we use, go ahead and just comment below, and we'll provide that to you. So through that, your due diligence is, you're essentially and this is what I've learned, looking for reasons why not to buy the deal versus reasons to buy the deal. So there was nothing that really came up that was out of the ordinary. One thing I did see as we were walking all the units, there was a stripper pole in one of the units. So I don't know if that's a plus or a minus or whatever the case is on that. So as we got through the due diligence, nothing was too alarming through that. So we, in essence, pushed it to closing. One of the things that did happen was, we didn't have all the cash actually raised for the actual closing, so we actually had to push that back. And that's one thing I always mention to people. They say, do I find the deal first or do I find the investors? I say you want to do both, because you don't want to get a deal under contract and then you start to try and raise money, because in that case is that, let's say you don't have all the cash, because the title company, you won't close the deal unless you have the money in your bank. It's not that, oh, I've got this on the way, I got some checks, some wires. No, you have to actually have it in the bank. So you want to have those investors ready beforehand. That way, when you actually have a deal, you already have your soft commitments with that. So the structure of this particular deal was, the purchase price was, as mentioned, it was $6.2 million, of which the raise was $2.8 million. So a portion went towards the improvements, a portion went towards the down payment, then an equity split to the investors of 85% went to them, 15% went to both my partner and I as the general partners. How we came to that was, it comes down to what return you want to give to your investors. This is a common question. And what that means is, do you want to give them, let's say, 12% cash on cash, and then in 3 years you want to double their money? Now you're able to back into, okay, what now you can play with the equity split. So as I give you an example, is that, let's say you have the split of 85 goes to your investor partners, 15% goes to you, but that only gives a, let's say, an 8% return for the cash on cash, an example. Now you may have to give 90% or 95% in order for them to get that 10%. That makes sense. That's where you start to tweak things. And so that was the structure on that. And how it was when it came to the financing is, the lender actually provided a line of credit for the improvements. And it was on a 8-year term, a fixed rate of 4.2%. I mentioned 8% return, fixed rate 4.2, amortization over 30 years on a 3-year interest. It was able to get 3 years interest only. So the total loan was about $5.7 million. And one thing that I do want to mention to you, because this is also something that most people don't know until they actually start doing these deals, is that the lender wants to see, of one of their requirements, or a couple of they have many other requirements. So I'll say among their requirements, they want to see that your net worth is greater than or equal to the loan that is being provided. So this, in this case, is $5.7 million. So the general partners, the people putting together the deal, need to have that or greater than. If you don't have it, you can find a co-signer, in essence, which is known as a key principal. And then they want to see that you have 10% liquidity of that loan that is being provided. So that's just some details on how this particular loan, or the loan, was provided, and also the structure with investors. I'm not able to go into the specific returns just due to, I don't want it to be general solicitation or anything, or it'd be gray. So by the way, this is not a general solicitation for this deal, because one, it's all, the money has been already raised. But let's go ahead and go into the business plan. All right, so just finishing out, the business plan was to go in and modernize the interior units, as well as there's quite a bit of deferred maintenance that was on the outside of the property, one being the roof. So there's a total of 16 buildings at this property. Majority are 2 bedrooms, but as far as the layouts and floor plans, but there's a total of 16 buildings, of which 12 are pitch roofs, and then there are actually 4 that are flat roofs. So those actually, through the inspection, actually had to replace all of those. That came up, and then their windows needed to be replaced. The parking lot also needed to be repaired, so seal coated, restriped. Haven't done that just yet. That'll be in the as well as the future with doing that. But the interior upgrades, and with that is doing vinyl plank flooring throughout, and the bedrooms doing carpet, resurfacing the cabinetry, replacing the what do you call that? Not the cabinets, the countertops with Formica, two-tone paint scheme throughout. So gray on the base, white on the trim. I know I'm going a little bit into the trenches, but that's the had to more modernize that. And then the cost per unit for those renovations were $13,000. So it was a pretty good size rehab. And that $13,000 includes the interior as well as the exterior. So the common areas, the roofs, and it includes everything. The full scope of work with that is about $13,000 on a per unit basis, and increasing the rents up by $116 on the per unit if you look at it across the board. So that was the business plan on that, and expect to stabilize the property in about 2.5-3 years to where everything is on the market rates. And this is a common mistake I see people make, is that when they have on their underwriting that year one, especially when you're doing a deep value add such as this, is that they have year one that the property is going to be stabilized. Is that one, there's leases that may have just been signed for 1 year or even 2 years. So you're not able to just simply acquire the property and say, hey, by the way, just want to let you know, we just bought this and we need to renovate your unit. So you have to get out so we can execute our business plan. No, it doesn't work that way. Tenants and residents have their rights. So that's why it takes a little bit longer. And then you want to protect your downside too, because things do happen. I remember for the first project that we had on the apartment side, is we ended up that year having one of the worst winters, which was pretty bad. And of course that ended up pushing back because it was very cold, a lot of snow that came in. So we weren't able to get contractors out there. So that ended up putting delays on the project. So we want to be conservative and not on the aggressive end. I know everyone has a different model, but that's just a personal experience share. So that is how the deal was put together. Right now, currently going through the reposition. So just in summary, the deal was found, going direct to owner, taking that approach. They verbally accepted the $7 million on my mishap, had to recounter, and luckily this was all on the front end of $6.2 million. They accepted it during due diligence, just had to confirm all our assumptions that were on the front end, which we were able to do. Nothing out of the ordinary ended up coming up. The water bill was still something of concern, but we just decided to take that risk, which we were able to push that down just a bit, as well as went into the financing deal structure of what it was like with the investors, and then also the financing piece, and then the business plan. Now, the lessons learned. So the first lesson was, once the property was actually acquired, our construction manager made a mishap that the quote that was sent over for the cost of the roofs, there's a total of 16 buildings, of which he thought that quote included all of the roofs. However, it just included the pitch roofs and not the flat roofs. So once we acquired it, our roof costs ended up going up from that. Just a little mishap on that. We ended up recovering through the interior costs because we were able to push that down. The next is be conservative on your underwriting, because that's just a prime example of things do come up, and with that is you just want to protect your downside. And the last but not least is just going direct to owner. That's been my go-to on that. Had success, and now already receiving offers on the 3-year projection. So that's the story, you guys. Would be curious on what is your biggest takeaway. Those of you on YouTube, comment below, and also like and subscribe, as well as hit that notification bell if you haven't already. Those of you on the podcast, leave that rating, especially if you gotten valuable information from me. I literally just distilled multiple months or close to a year into however the time frame on this is going to come out to be. So bear with me if there's some things that I didn't cover. Go ahead and reach out to me, and happy to elaborate a little bit more. So those of you who want just more insights on how to bridge the gap from where you are to where you want to go, and how to properly structure deals or even go direct to owner, there's a link to be able to schedule that strategy session. Until then, appreciate you. Keep being awesome. Be great.